Welcome to Community Crypto on CoinDesk TV. I'm your host, Isaiah Jackson, and it is tax week at CoinDesk. And today we are discussing crypto taxes, especially this year due to the rise of NFTs, DeFi, and DAOs. Full disclosure, this is not financial or tax advice. And I am joined today by Charles J. Kelly, aka CJ the Smart Guy, a CPA and founder of SmartGuy Taxes. Welcome to the show, CJ.
Thank you. Thank you for having me.
Oh, yeah. Always good to have a professional on to discuss one of the hardest subjects in the crypto world, taxes. And I know everybody's scared. We're here to make sure everybody gets the information so we can get rid of some of that fear. So first question, I wanted to ask CJ, how exactly did you enter into the Bitcoin and crypto market?
Yeah, for sure. So I got into the crypto space 2016, 2017 after I watched the movie Dope with A$AP Rocky. And then I studied it more after my mentors, Nipsey Hussle and Dr. Boyce Watkins. They were saying, hey, check this out. So I studied it more, did my own research. And, I was studying for my CPA exam while I was studying cryptocurrency. And then when the Black Bitcoin Billionaires on Clubhouse came out in December 2020, all of a sudden I had my community. So that's a little bit of the story.
Oh, yeah. Yeah. And it's funny how fast things happen, right? You get into the industry and then boom, here you go. There's thousands of people that you can work with, right?
Yeah, for sure.
Oh yeah. And based on, your experience and your expertise when it comes to the crypto tax industry, are there enough accountants who have the knowledge to prepare taxes? And is there more education needed, you think?
Man, you hit a very huge question. Like there's a lot to that. So first, there's not enough accountants to do all the tax work. There's not enough accountants that even understand what cryptocurrency is. And then on the flip into that, you may have some of the younger people who are interested, but then the veteran CPAs and tax preparers, practitioners, if they've already made a lot of their money, they're not really trying to get into this new space because this isn't like real estate. This isn't like stocks. This isn't like trusts. This is a brand new financial system. And most people that are successful in the current financial system don't want to learn an entire new system. So I just happened to come up during a time period where I was struggling. The banks closed my account and I was just studying cryptocurrency and the CPA at the same time. But most CPAs I talk to, they just don't want to know anything about it because it's a whole new system and it takes too long to learn.
Yes. And hopefully that sentiment changes because I've talked to a lot of accountants and you're right. They have no clue about the crypto world. They don't care. And in my opinion, they might not have a job if you can't do crypto taxes at a certain point because it'll be a part of the industry, right?
Yeah. I think, if we look around the world with the rise of CBDC, central bank digital currencies, when you add the blockchain technology in there, as a CPA, as an accountant, or even as a bookkeeper, the goal is to keep track of all the different transactions, to categorize them amongst the different categories like advertising or car, truck expense, things of that nature. And if all of a sudden we have a CBDC where those categories can be automated, then that takes out a nice percentage of accountants. And then with the CBDC, if there's like a flat tax on it, then, what do you need complicated internal revenue code taxes? You don't need somebody for that. It's just automated. If anything, you just need somebody to audit, double check to make sure it's correct.
Right. Oh, yeah. So, yeah, a lot of new technological advancements have made it so that the accountant side of the world, it'll either be automated, like you said, or they'll just be auditing the auditors, so to say. But one thing I wanted to get into is let's jump right into it. What are the exact tax implications for crypto and crypto transactions? Exactly how do people actually file their taxes and what things are tax liable?
Yeah, for sure. So the first piece before we get into the transactions is on the 2021 tax return on the very first page of your 1040. There's essentially a question that asks, have you ever done any cryptocurrency trading? It'll say like virtual currency. And essentially that box, if you click yes, and, actually, let's say this. If you click the box no, but you have been doing cryptocurrency trading, you've KYC'd in some of these exchanges, that's just an easy way for them to pop fraud into you. So what I normally tell everybody is check the box yes, take fraud off the table, and then we can start getting into the actual transactions. Cryptocurrency taxes are actually pretty simple in theory, in the sense that only if you trade cryptocurrency, so you trade one crypto for another crypto, you spend cryptocurrency, or you sell it for US dollars. Those are the capital gain taxable events. And then, of course, if you earn crypto from a business, or you accept cryptocurrency for goods and services, then that's taxed as income. And so those are the main sources. Of course, you got interest, dividends, possibly staking rewards. We're going to see how the IRS plays out with that. But for the most part, if you spend it, if you exchange it, or if you sell it, those are the main taxable events.
Oh, yeah. And that's the very basics there. But I kind of want to jump to the advance, because I think most people, they understand capital gains. Okay, I understand that. But one thing I want to ask is, in the new digital economy, should the tax law sort of be edited for things like you just stated, staking, airdrops, some of these things that are kind of in the gray area as far as taxes? What exactly are the tax implications for something like staking, or, for example, an airdrop?
So staking, so the way that it's been taxed when it comes to the IRS is that whenever you get staking rewards, that's considered income. And so there has been multiple court cases, especially there was one, I believe it was in Tennessee, where it was a couple that said, hey, if I own real estate and I grow apple trees from my property and I grow apples from my trees, I don't have to pay taxes on the property that comes from my property. And so when it comes to staking rewards, if you have property, which cryptocurrency is considered property, and you have property that grows from your staking rewards, why are we being taxed as income on this? And the IRS essentially said, hey, you're correct. We will give you your refund. We'll give you some more money. But then the couple said, well, we don't want just our money. We want to make sure that we get to this actual principle. And so they said that we're going to take it to the higher court so that we have additional clarification from the IRS. We're still waiting on that. So when it comes to staking, as of right now, it's considered income, but chances are that will be changing going forward. We're just waiting for some more guidance from the IRS.
Oh, yeah. Yep. And definitely need that clarity so that people know exactly what to do. And with airdrops, I was having this discussion. I know somebody who received an airdrop, ENS, to be more specific, and they did not know that they received that airdrop. So how is that with taxes as far as how will it be taxed, or is it considered a gift? How are airdrops looked at under the tax code?
Yes, this is definitely a gray area because technically it's not considered income until you have domain and control over your asset, in this case, cryptocurrency. So if you don't know that you've received an airdrop, then how would you even quantify that, because you don't have control over it and you don't have dominion over it because it's not in your possession, because you don't even know that you have it. And so, when it comes to that, what I would normally tell people is, hey, if you receive an airdrop, I personally report it as income. There are some people who will say, hey, that's a gift. Some people will say, hey, that's a gift of equity. I just take the safe side as a CPA. I'll include it as income on my end, but if you decide to do something different, the IRS, they'll figure it out. I think the biggest thing is any transactions that are over $10,000, there will be additional tax enforcement in cryptocurrency for anything above that. So if we're talking about, a couple $100, or wow, I got a $20 airdrop, I personally report it. But if you don't, I don't think that you're the one that they're intentionally coming for. Just make sure you check that box yes on the front of your 1040.
Oh, yeah. Yeah, just to be safe, absolutely. Listen to the CPA. Always be safe when reporting, just in case. And there's a few other technological advancements that have boomed over the last year, one of those being NFTs, or non-fungible tokens. Those have become very popular. So please explain to our listeners, how will NFTs be looked at as far as taxes going forward?
So going forward, not quite sure as of right now. The way it's done is, so say if you buy an NFT, whatever you buy it at, plus the gas fees. People have asked me that about Ethereum because gas fees are really high.
Right.
The gas fees plus the cost of it is considered your cost basis. So that's the total price. And then if you decide to sell it, the difference between what you sold it at minus your cost basis is your capital gain or loss. Typically, that's done at the 20% level max for capital gains. However, if you're a high income earner, it may be considered like collectible art, and it may be a 28%. So a higher, you bring in more money. If you are a creator of an NFT, then once you create it and then you sell it, and at that point, that's considered income. And then if you have residuals, that's considered like royalties, which are taxed at a lower level as well. But as of right now, that's what the NFTs are taxed at. It really, I feel bad for a lot of people who buy all these NFTs with Ethereum, and they're having to pay all these different capital gains with every single, purchase, because you're purchasing an NFT with Ethereum. So just be very, very mindful of that, especially when it comes to your CPA, because most of us charge per taxable event, and that can add up very quickly.
Oh man, yeah. I know a few people who have run into that problem. And one thing I wanted to ask about the NFT market specifically is there was a story that Melania Trump, she actually put out an NFT, and when they found out that the price of what it was bought at, they found that she bought her own NFT. So
Yeah.
we've seen this. Me and you, we've been in this market long enough to see where there's some wash trading with NFTs. People making the floor higher just by buying their own NFT. What would you say to those people as far as taxation goes? What are the implications for that? Because you said it's considered income, but if it's my own income that's paying for it, what do you do there with that situation?
So I will say is that in this crypto space, as of right now, there is no wash rule. Like in stocks, if you buy it at 60 and then all of a sudden it's at 30, and then you sell it at 30, you can't just rebuy it back to take that loss. You have to give it a certain amount of time. With crypto, you don't have to do that. You can do it instantaneously. So from a tax perspective, what I would tell her is if you create an NFT and let's just say you sold it for $100,000, at that point it's income. And then if you then buy it again from somebody else, or you have a different company, or you're doing all these different things, not only did you pay income on that, but then you may have to pay a capital gains tax on the sell of the next one. So you're really creating a tax headache for yourself. But I mean, if at the end of the day you make a big enough profit, it might be big enough to offset the taxes. Most people look at taxes as the very last string. It's not the first thing you think about, is what you think about on the back end. But if you're doing that, you got to take that into account for sure.
Oh yeah, a whole lot going on there. And that sounds like an accountant's nightmare. Somebody comes to you with 100 NFTs that they've all wash traded themselves. Man, I'm getting a headache thinking about it. Moving on to some more technology, because again, this is such a fast moving market and fast moving sector. The tax implications sort of can't catch up, but DAOs, decentralized autonomous organizations, have become very popular in the past few years. How would a DAO be taxed since they don't have, the traditional business structure and there's no one entity to go after? How are DAOs taxed?
Yeah, so essentially they're taxed the same as a corporation. That's typically in Wyoming. From my understanding, like Wyoming's the only one that's really pushing forward with these DAOs. There are some other states that are trying to move forward. But for the most part, when it comes to DAOs, I would just treat them like corporations as of right now. You can possibly choose whether it's LLC. That might be taxed different than a C corporation. I think the biggest thing is to be consistent with whatever you do, be transparent with it. And then from a legal perspective, make sure that it's the correct legal entity. And I know Wyoming, they're big on that. But as of right now, there's no like huge difference between a normal business versus a DAO in terms of taxes, bookkeeping, reporting, things of that nature. You just want to check with your local state to make sure that you're complying with all of their local rules. But on a federal level, I would just treat it the same as a corporation or as a flow-through entity such as a LLC.
Oh yeah. Thank you for that clarity. I know there's a lot of people spinning up DAOs, just getting started, raising money, and not really looking at that clarity. So great to have that. And we've discussed NFTs. We've talked about DAOs, crypto to crypto purchases, capital gains, all of that stuff. But I have to ask you, CJ, do you think taxation is theft at its very base level?
Yes, to a certain degree. Meaning, say if I work a job and I make $50,000, I have to pay taxes on that income. To some degree, I understand that because we need federal, we need military, we need certain things to protect us. And then once you get that, then when you go spend it, you have sales tax. That's for your local government. Then if I have employees and I pay them, I have to pay employee tax, and then they have to pay income tax. And so when you just look at the wide variety of taxes that we're paying, I just think that that's incredibly high. I think that me being a CPA, I look at the whole broad scale and I look how, if you're a low income earner, you kind of like taxes because they normally give you some type of subsidy to help your life out. When you're middle class or you're single with no kids and you're just a worker, it is definitely taxation because it's like, why am I, if you're in New York, you might be, being taxed 30-40% and your rent's really high. I think the biggest taxation really comes in the form of inflation. I think that taxes can definitely be reformed for sure. In the crypto space, it makes absolutely no sense in terms of the way it's taxed and its utility. However, when it comes to inflation, the printing of money, I think that is the biggest theft out there possible because you're devaluing people's hard-earned income every single day. They follow the rules, and they didn't know 5 years ago when they decided to save their US dollars that you're going to print out 40% of the supply. I think that is worse than taxes, but taxation without representation is what this country is based off of. So if I'm not being represented, then it's definitely theft.
Oh yeah, no taxation without representation. And I'm glad you answered that truthfully because there's a lot of people who they'll look at the broad market, they'll look at estate taxes, property taxes, all of this stuff, and still say, well, it's good, right? And at some point, you got to say, hey, man, we're moving into a whole new future with new rules needed, right? And I wanted to propose this to you as a CPA. You can explain whether this will work. Do you think the tax code could be changed if we had an organization sort of like a DAO for America, so to say, where all of the money that's submitted via taxes, you could also code into the contract what they want it to be spent on? Wouldn't that be a better way to accumulate tax revenue?
I think that would be great. I look at certain city coins, and I think that the voting rights for some of those things is going to become important because if you look at your local governments, I think local governments are more important than the federal in terms of like what you want to get done. And so I think that if you're paying taxes, you should be able to choose what it goes to. I think that when it comes to budgeting, Congress has so much power that, they can do insider trading and it's legal. And they have all these different, double standard rules for themselves. They have insider everything. And we're the ones paying the taxes because most of the wealthy people, they hire people like me, so they don't pay hardly any taxes. And the money that, they move to other places actually gets to go towards what they want. If they donate to a 501c3, they might be able to get a building named after them and avoid paying taxes legally. And at the same time, it's still considered marketing, but, it's a tax write-off, to some degree. So, I just look at it and I definitely think that there needs to be a change. And with this crypto space, if the DAO is the best way to do it, I think that'd be great. I think that simplifying the tax code would be huge. I forget how many pages it is, but it's like 15,000 pages or something. And nobody's read the whole thing. We just try the best we can.
And see, I think that's the promise of the Bitcoin and crypto world is the fact that we can simplify the tax code. We can slim it way down. And then as far as how taxes are spent, I think you get more say over that. So I would love to see a crypto task force for taxes where they have people like yourself who come from both of those backgrounds. So would love to see that. Maybe you can start that in the future. That would be great because I can tell you right now, a lot of people are very confused. Even with the advice, they'll still be confused over what to do with their crypto gains. So let's look at some of the strategies that are available for people to reduce their tax liability. Like you said, tax evasion is illegal, but tax avoidance is not. So what are some things people can do to reduce their tax liability in the crypto market?
Yeah, for sure. So one of the principles that I know you preach and Lamar preaches, Naja preaches is dollar cost averaging. If all you're doing is dollar cost averaging, meaning you're buying on a daily or weekly or some type of interval basis, that helps out with the taxes as well. Because if you buy, hold, and you never sell, there's never a taxable event. So that's a way to accumulate without paying taxes. And then one of the strategies is called tax loss harvesting, where let's just say, Bitcoin, I believe it's around like 38,000 a day, something like that. You can add up all the amount that you've accumulated of Bitcoin that's been above 38,000. And you could say, okay, I'm going to sell that amount of Bitcoin and take a loss. It's like a built-in loss that can offset some of your potential gains. Short-term losses offset short-term gains, long-term losses offset long-term gains. And so from a strategic perspective, most of my clients, when there's a big dip like this, we sell and rebuy back the dip immediately, so that we can take that built-in loss, so that going forward we have that loss. And it's really easy to do that when you're dollar cost averaging, because you can just look at, okay, the spot price for today was, or for these days was above what it is today, and so it's easy to sell that amount, versus people who are going from one exchange to another, trading, spending, man. And when it comes down to the pricing for a CPA, if all you're doing is buying, holding, and never selling, we're not putting in too much work at all. So it's not expensive. But if you are doing a lot of trades and you're going from one exchange to another, I mean, it pays the cost to be the boss, right?
Oh yeah. And I think that point gets missed by a lot of people. And some people have called me and, like you said, Lamar from Black Bitcoin Billionaires, like Bitcoin maximalists. When in reality, we're just trying to save people from themselves. They don't realize jumping in and out of cryptos and other exchanges back and forth, all you're doing is giving your CPA or your accountant a headache and yourself. Because I believe you said it before, the IRS doesn't have an expiration date. They can go back however many years they want to try and figure out what you were doing back in 2018 or 2016. To figure that out. So if you don't want the headache, jumping in and out of a lot of cryptos is probably not the best strategy, unless you want to give your accountant a headache. So one thing I wanted to ask too is in the future, we have the adoption of Bitcoin as legal tender in El Salvador. We're seeing that in places like Russia, Argentina. They're discussing it. Will it make it difficult to justify taxing an asset that's not native to the U.S.? So, for example, if I have Bitcoin and I sell it for another currency, so to say, will that sort of throw a wrench in the tax implications currently?
Yes, but I'm not. That's a change that I'm looking forward to, because right now the Internal Revenue Code is based off of the U.S. dollar. As of right now, that is the standard. So regardless of whether it appreciates versus a different currency, such as the Chinese won, or it depreciates, then that's the standard. And so if Bitcoin becomes the standard, then at that point, then there shouldn't be any capital gains losses anymore, because we don't pay capital gains taxes on the appreciation of the US dollar versus a Japanese yen or anything like that. So it will change. But if Bitcoin becomes legal tender in America and there's no capital gains tax on it, I think that'd be great. I think there was a bill that was actually just proposed, it hasn't been passed, that said that if there's transactions under $200, then there wouldn't be capital gains tax on it. And I think that's a way to push the spending of cryptocurrency and using it as actual currencies versus property, which makes very little sense in the great scheme of things.
Oh yeah. And you're right. I mean, the code, we would love to see it change. 15,000 pages, like you said. We would love to see that whittled down just a bit. And we're changing overall. I mean, I know this isn't purely tax related, but when you look at the Securities Act, for example, we're talking about 1933 people. These are very old laws that are being enacted today. And one of the things I wanted to ask, this may coincide with the tax part of it. What if one day Gary Gensler, head of the SEC, wakes up and says everything but Bitcoin is an unregistered security? What would that do for the tax market? Would they feel like, hey man, I just paid taxes on this. How is this security now? Or what do you think the tax implications would be with that?
So the thing is so from a CPA perspective, I do believe that pretty much every single cryptocurrency outside of Bitcoin is a security. Personally, I think that, Ethereum, because, if you have proof of stake and you have a certain ownership percentage that is owed to you, or you have available to you, then that is a security because you're trying to enrich yourself. You can look at the Howey test and judge for yourself. But I believe that almost every single cryptocurrency outside of Bitcoin is a security. It's just, who cares? I think that when it comes down to, like you said, 1933, there was another law that was passed around 1933 and 34, and that's the one that made gold illegal to be held on to. You couldn't hoard gold anymore, so the government came and seized your gold. That's a time period. Then they said, okay, well, now we're going to keep you safe with your investments. We're going to take your gold, we're going to give you this paper money, and we're going to make sure that you're safe from these investments. And so I think that law is completely outdated. And then when you look at the amount of time, I mean, you look at the case with the XRP case that's been around for so long. If the SEC was going to come after them, they should have done this 5 years ago. They shouldn't have waited until people put their life savings into some coin. You're going to hurt the people more than you help the people. And if they decide to do that, I think there's going to be a huge backlash. That at the end of the day, as a CPA, I'll make sure you do whatever the law says, but it's going to be a lot of law changes and a lot of pushback for sure.
Oh, yeah. And I would hate to see some of those people that follow the letter of the law only to see it change the next year. So it's going to be a crazy time. And one last thing I wanted to ask, and this has been sort of a meme in the Bitcoin community. What are the tax implications for my Bitcoin and crypto if I lose it in a boat accident?
So what I will say is you could take it down as a loss. I've told everybody that you could do that. However, if it's ever found that you still have dominion and control over it, at that point, it would be considered fraud or evasion. And at that point, you'd have to deal with the legal side of it. But if you actually lose it in a boating accident, you should be able to write off your entire cost basis. So say if you bought Bitcoin was at $100 and then you lost it when it was at 80,000, you can't write off the 80,000. You can only write off what you bought it at, which would be the $100. But you could write it off if you legitimately lose it. Some people have said they lost it and they refound it. At that point, I would either try to amend that other tax return that you lost it on, or you would just say, hey, write it with the government. Hey, I did buy it back. I did find it. Make sure you document it so that you don't get any legal trouble. I think the biggest thing that as a CPA I'm trying to do is avoid people from committing evasion or fraud. Right. You do not have to report how much Bitcoin that you own. If you just buy it and you never sell it, you never, exchange it, you never spend it, you don't have to report how much you own. So, it's not about just saying, hey, government, here's everything I have. No, it's not about that. It's about playing the game smart and just knowing, hey, these are the rules, play by the rules, and try to stay low key as much as possible.
Oh, yeah. Play the game smart. And that's why we got you here, CJ, the smart guy. Thank you so much for coming on the show today to discuss taxes for our annual tax week. I appreciate you, CJ.
No problem. Thanks for having me on.
Thank you. That was CPA Charles J. Kelly, a.k.a. CJ the Smart Guy, joining us today as a part of Tax Week. Visit CoinDesk.com/tax week for special tax week coverage consisting of 35 guides, articles, and op-eds from leading experts. And that's it for this episode of Community Crypto. I'm your host, Isaiah Jackson, and every week we're building a global community with local crypto. So be sure to tune in every Thursday at 4 p.m. Eastern on CoinDesk TV. See you then.